Welcome, everyone. I'm going to wait just a minute or two to let all of you attendees cycle in, and then we'll get started. All right. Hello, everyone, and welcome to How to Survive a Recession, Personal Planning Guidance for 2022. We are so glad you joined us this morning. Now, before we get started, just a few quick housekeeping items. This webinar is being recorded, and you will receive the recording link and slides emailed to you later today. Be on the lookout for that in your inbox. This webinar will run 50 minutes with 10 minutes Q&A at the end. If you have a question for our presenters, please put it in the Q&A box located in your Zoom toolbar. To find your Zoom toolbar, just hover your mouse over the bottom or top of your screen and it will pop up. Look for the Q&A icon. Now I'd like to introduce to you our presenters. Robert Daly is a Managing Director of Investments with the Summa Group of Oppenheimer & Company. He takes special care to establish a big picture view of clients' overall goals and develops planning strategies that often include the input of the client's other trusted advisors, such as their CPAs, estate and business planning attorneys, trustees, and banking professionals. One of the core strengths he provides is the ability to simplify his clients' financial lives by providing advice and guidance based on time-tested investment and planning principles. Robert resides in Glendale with his wife, whom he met at Pepperdine, and their 4 children. Traveling, cooking, sports, scouting, and philanthropic work keeps the family happy and very busy. Maria Ariola is a partner at LSL CPAs and serves as a trusted advisor and partner to closely held business owners and their key personnel. Many of her clients came to her as growing businesses looking for advice, guidance, and collaboration beyond the traditional tax and assurance services. For over 30 years, Maria has worked alongside her clients to help them successfully navigate their growth phase while strategically planning for future goals, including growing, preserving, and managing wealth, retirement planning, succession planning, and positioning their company for IPO or sale. Outside work, she enjoys spending time with her husband and children, doting on her 2 new granddaughters, and keeping very busy with her large extended family. Take it away, Maria.
Good morning, everybody. I think Jill forgot the fact that once you get the grandchildren, all of a sudden your pocketbook is just out of control. What is it about me going anywhere and cannot go buy something for those little girls? It's crazy. My son sees me coming, goes, "No more toys, Mom. No more clothes for their grandchildren." It's amazing how crazy it can be. Anyway, thank you everybody for being here. God bless. Thank you for joining us. This kind of seminar always takes a lot of effort and a lot of discipline to put together. So the first thing I want to say is thank you to our marketing team. Without them, we would be nothing. And then Robert, of course, and the Summa Group and Oppenheimer worked together for 25 years and absolutely adore you. What I love the way that Robert really brings out is all of this that you're going to hear. I'm not going to lie, you've heard it before, but sometimes you're going to have to hear it to make yourself do something. So if I can ask you one small item is hopefully you can take one action item from today, whether it's for your business, whether it's for your personal, and make yourself just one thing and do it to help you with your future. And I promise you, I really think that you're going to feel better about it. I'm exactly like you, where I sometimes just hesitate and I have to just put my shirt on and say, I got to do this. I got to be a big girl and I got to do this, whether it's a hard thing to accept or not. So with that, let's start about the seminar. Let me go through. Robert, if you could put the next slide for me.
Yes, here, hang on one second.
No problem. Yes. So what we'll cover today in general is portfolio rebalancing, what it means, why should we do with this all the time, what's happening in the economy today, what should we do? Retirement planning. I know that if you're like me, I probably am embarrassed to tell you, but I probably really don't even open my retirement accounts for the last 4 months because I would probably be sick to my stomach. But it is important to make sure that we talk about that. Budgets Balance sheets, I didn't write that in there, but cash flows, really important to talk about it now. Expenses, whether it's for your business or your personal, we got to talk about them. What does emergency savings mean? What do we do now with our credit and our debt right now, especially interest rates going up? And should we be paying? Should we not? What are we doing? And then, of course, the business considerations such as inventory and things like that. So it is a general, it's only 15 minutes, but we're going to try to hit on a few things. So if something catches you, please feel free to either ask now or just chat with us later. As you know, both Jill and I are available pretty easily, and I know Robert is too. But anyway, Robert, take it away. He's going to do most of the chatting with us, and so we can learn from him.
Yeah, thanks, Maria, for the kind introduction. And yeah, just to give a 2-second overview of the team here, we are a 12-person wealth management team within Oppenheimer. We're called the Sumo Group. We run just north of $2 billion for a number of families, entrepreneurs, business owners, some folks in the entertainment industry, mostly here in Southern California and Northern California. So with that, one of the topics that keeps coming up, obviously, is this impending recession. If we're in one, if we're going to have one, if one's coming. And so with that, I wanted to hit on the first point, which is portfolio management and really asset allocation. So, one of the things that people ask is, what can you do during an environment like this? And sometimes the best offense is a good defense. And so we think asset allocation and diversification are some of the only things in free lunch you get in investing. And so, we always ask clients, do you know what your asset allocation is? A lot of people don't. So that's one of the first steps, is to really know what you own inside of your portfolio, before going into these types of environments. And for us, one specific strategy that we've used and taken advantage of both in 2020 with COVID, and then also in the current environment, is tax loss harvesting. And that's just a process of where we sell certain assets and rebuy other assets and position a portfolio so that it harvests some losses along the way, so that when the markets rebound, you don't pay any tax. So if anyone hasn't been doing that in taxable accounts, we highly recommend it. And everyone's situation is different. So we always say, go to your CPA and double check with them. And then, another point that I wanted to make here is kind of what's the difference between 2020 versus 2021 versus 2022. And when you talk about tax loss harvesting, there's this period where the markets went down in 2020. We were able to do some tax loss harvesting. Markets rebounded. We didn't owe very much tax in the portfolios. 2021 was a good year financially for financial markets. And now you look at 2022, and what happened is a lot of gains were pushed out from 2021. And we're kind of in a similar situation now as we were 2 years ago. So one really important thing, and one huge mistake we see people make, is they base their tax projections based on the past and not what's going on in the future. And so, Maria, I don't know if you want to hit on this point, but why someone should reach out to you on this.
Absolutely. No, thank you for doing that. Most of my clients, pretty much 99% of it, we had a tax bill in 21. Some of them not even expected, because the capital gains that were being thrown off in an incredible market of 2021 was exciting. It's better to get 60 cents out of the dollar and pay your 40% tax than get zero. So I love that, but we didn't always have enough losses to carry over. So when you did your 2022 estimated tax payments that would have been made in April when you filed, or maybe even later if you had extensions or whatever, is based on the safe harbor, which would be your 2021 tax. So you may want to reach out to your CPA. If it's not me, if it's me, I've already been talking to, but if it's not, and I don't, when I say me, I really mean LSL, because I feel that's us. And it's worth talking to them, because if your cash is a bit tight right now and you're making these huge estimated payments, but let's say you're a real estate commercial And I had one of our clients that said, hey, listen, had somebody move out. They were in a retail business and 2022 kind of hit them. So now I have 20% less. I don't expect this much for 22. So make sure that you take the time to adjust your 22, because I can probably guarantee you that it is not going to resemble 2021 at all, especially, and I understand what you're doing with lost harvesting. And I want to make sure I say it in my own words for that. That doesn't mean that we're going to have all these losses that we can take in 2021, because losses are limited, especially capital losses, to a really small amount. But what I want you to think about is let's harvest these losses, because in 22 or in 23 or in 24, you may be selling something. You have a future with some plans. This market, as you know, as we all know, every 10 years, it does something. Sometimes you'll get it pushed a little bit farther, but it's basically every 10 years, it likes to mess with our brain. So what we're doing is holding on to some of it so that when tomorrow comes and you have some gains, it'll offset it with what you have. But that's my main thing. I wanted to ask you before you move the slide is when you mean asset allocation, Robert, one of the questions our clients are talking to you about every quarter when we meet is, do I change my asset allocation? Is it because, you know, the market is like that and we're allocated, let's say 30% to the equities and 40% to alternatives and 30%, whatever adds up to the 100 in fixed. Should we be messing with that? Have you guys been seeing differentials that you get out of and not?
Yeah, so I mean, asset allocation should be thought of as a long-term strategy. So what you're kind of referring to is what a lot of clients refer to as market timing. So when you're looking specifically at like retirement assets, which we call long-dated assets, something that you're putting money into, which we'll talk about dollar costing in the next slide. If your current situation hasn't changed, meaning you have a job, you have income, you have assets, everything is relatively the same, but the market has changed. You know, you can obviously make little tweaks around the edges, but your asset allocation should predominantly stay the same. And in fact, you know, we look at recessions or market dislocations as opportunities to increase risk in those assets. If you have the mindset of not touching this money for 10, 20, 30 years, you want to take advantage of that. If it's taxable money or trust money, again, everyone is very specific based on their situation, but in general, with taxable money, we tend to be more conservative. You have to, you know, take into account tax planning. But again, you know, you don't want to make drastic asset allocation changes or go all in or all out of one asset class and make these drastic moves when the markets are doing what they're doing right now. You have to have a more of a long-term, you know, viewpoint. We've been here before. We've gone through different market cycles, and over time, things tend to repeat themselves.
Thank you.
Yeah, and again, it's very client specific. You know. Here, let's flip to the other slide here. Okay, so I had mentioned something about dollar cost averaging. This is really important with retirement assets, whether it's a profit sharing, an IRA, 401k, defined benefit, any of these like long dated retirement assets. You know, as markets are declining and bouncing around, you want to take advantage of that. Again, not trying to time markets, but just being consistent and, you know, dollar costing or averaging into the markets every month. That could be adding $500, could be adding $1,000, could be adding 10,000, could be adding 100,000 every month. It just depends. It's very specific to each individual. But with inflation, when you think about inflation, you know, means that goods and services are costing more because of a declining dollar or a weakening in currency. And to me, that's a sale. And when you're dollar cost averaging, you're adding money and buying stocks at a discount, again, over a long period of time. Maybe not today or tomorrow, but over, you know, 1, a 3, a 5, a 7-year span, you know, you're going to make your money on the buy by buying assets cheap and consistently doing it over a long period of time. That's how well.
Yeah, and I'd like to add something to it. is this may not be the bottom, but trying to figure out or guess when that bottom is will not help. You have to be able to every month, if you continue putting money and buy at that cost now, and then maybe next month it'll be lower, and maybe the next month it will be lower, you're not missing out. You'll never be able to guess when the bottom is going to hit, unless you're a genius. Call me and then maybe we'll talk about it, but I doubt it. So that's one of the items that, like, for example, even my children said, well, should we stop putting money in my retirement? Like, no, this is the time you just keep going. We do have a cycle. It's always a cycle, and yes, we have some industries that are not doing that well, but that doesn't mean that this is going to shut Amazon down and it's going to shut, utility companies and all of this stuff. It's not going to happen. So anyway, I'll stop talking. Keep going.
Yeah, let's flip to the next slide here. And again, at the end, if
You want to talk about inflation and what it means to us right now?
Yeah, so inflation is, I mean, there's different definitions of inflation, but it's in a general sense, it's when the decline in the dollar, it takes more dollars to buy the same goods or services. So therefore, assets tend to appreciate in value, or certain things tend to go up in value because it takes more dollars to buy that same good or service. So we're obviously dealing with an inflationary environment right now. There was a lot of Fed printing, and then we had a supply chain shock with the war in Ukraine. That's obviously these are all unpredictable events. At the end result, the Fed, which controls the monetary supply, will increase interest rates to combat inflation. And that's one of the main tools that they have, is lowering and increasing interest rates. And as they increase interest rates, what it does, it makes borrowing costs go up for auto loans, credit card, home loan, corporate debt. And eventually, when those costs go up and the cost of debt goes up, people can't afford to buy as much, and aggregate demand falls off. And so what's interesting is that recessions are almost a natural way to bring down inflation, because as painful as they are, they reduce people from spending money. And so again, these are all cycles. They've happened before. They're going to happen again. And the trick with investing is to have a long-term mentality, to take advantage of the cycles, and to put a plan in place where you're consistently adding money into your portfolios, whether they're taxable or retirement. You just want to be consistent with it. Okay.
Absolutely. Thank you.
This is a really important topic: budgets and balance sheet and cash flow. So if you haven't done it, which I would say the majority of people haven't, putting together a balance sheet and a budget is something that everyone should do every couple of years, just to see where they're at in life. A budget's simple. It's just a ledger system. You're looking at money coming in and money coming out. How much do you have from Social Security, from rental income, from active income, from W-2 income, from business income? Like, what does that look like right now? And then what are your expenses? Your mortgage, your kids' college, your cell phone, your car loan, all those expenses. So when you put those two lines together, you have a plus and a negative. You can figure out really quickly, are you in a surplus or a deficit? Do you have savings, or are you short every month? And then if you're short every month, that's where you can go through kind of line by line and review your different obligations and figure out if there's something you can cut out to kind of shrink that number so that you're in a surplus. If you're in a surplus, that's great. What you want to do is save, build an emergency fund. If you already have that, you want to take the excess money and start investing it, or pay down your debts. So those are two different dynamics you can do. Another thing is looking at credit lines. Again, this could be for you personally and or for your business. So what happens during market downturns is banks tend to tighten up credit. And this happened in 2008, where people had large home equity lines, and all of a sudden they got a letter in the mail. Maybe they weren't using a line, and the bank just called it and said, hey, we're closing that line. So now you had 100,000, 200,000 of credit just pulled away from you overnight. So, I mean, that's a real possibility that can happen. It can happen with a business. So, you have a business that has different credit lines and the same thing, they're looking at accounts payable or receivable, and they decide to shrink those lines. So anytime you're in an environment like we're in right now, you just want to make sure you have access to credit before the market tightens up. I don't know if you have any comments there, Maria. On the credit
Well,
lines.
I do. The comment I have on this, that it's really great in writing, but it all depends where you are in your life. If you have small children, you have children that you're still going through college and you're paying, and or maybe you passed it like I have, but now I'm traveling a lot to see my babies and spending money that I shouldn't be. It does open your eyes to put it on a piece of paper. There are things that you can't do anything about, and then there are things you can do something about. I know that for a lot of people, the car industry, okay, I needed to buy a car, but I'm working from home. I have clients that said, why do I have two car payments at over $2,000 a month when we both work from home? And there, when the market was really hot, they sold one of the cars because they're both working from home. So there are things, I know that's radical, but there are things that you really can see when you're truly, a balance sheet is just a fancy word to write down, okay, what do you own and what do you owe? And it depends what time in your life you're at. It's something is more important than others. I'm not going to say, okay, well, if I'm running my kids and I have to pay college, I'm not going to be thinking about paying down my mortgage in 5 years. Let's just face it, that's just not going to happen. So it's just really important to see the long term. We talk about long term a lot, but it's a real hard concept to put it in real terms. And I'm the first one to tell you, I was just telling my partner in the coffee room that I'm really bad at it. I literally need to have Robert with, okay, you got to meet with me in a quarter, and you better not say no. And I can find every excuse in the world not to do it. I really can. I'm really good at that. But I'm telling you, it kind of puts it in there. It makes me scared a little bit. It's a scary thought, but I really think that it ultimately makes you feel much more in control. Once you get through that scary stage, now you go, okay, well, now I'm in control. Now I can choose of what I'm going to do. And even if it means, okay, I can't save a dime right now, that's okay. You're still in control and you're understanding what you have to do in the next 5 years. I just always feel that if you're on the driver's seat, in whatever the word is, in or out on the driver's seat, and you're in control, you will sleep better. The anxiety goes away. Life is just life. But if you write it down and you really pay attention to what you're doing, I really think that it's such a positive thing for you to do. And then have a nag, like a Robert that nags you every 3 months. Yes, that's really important.
I like to call it being pleasantly persistent, Maria.
Oh, yes, pleasantly persistent. I'm going to tell that to my husband and say, honey, I'm personal. What did you say it was?
Pleasantly persistent.
Pleasantly, I can't even say those words. My husband's never going to believe you anyway.
Yeah, there's also something psychological about writing things down on paper,
Yes.
setting goals, and just kind of seeing where you're at. Putting it in writing it makes it real.
Yeah.
Okay, so let's flip here, which kind of leads into what I call auditing your expenses. Just like companies audit their books, you want to audit your expenses. And what I mean by that is you want to go through and look at your Amex card and your Visa debit and look at all these accounts and just see, like, how many subscriptions do you have or do your kids have? And if you are in a position where there's a job cut or reduced income, you want to make sure you're actually paying for everything that you're using. And over the pandemic, people have loaded up with subscriptions and all kinds of things that they really don't need. So just go back in there and just kind of carefully look at your credit card statements, review your monthly bank and brokerage statements, and just make sure you're not paying for stuff that you really, really don't need in this type of environment. I also call this wants versus needs, or wants versus necessities. So we all have basic necessities: food, shelter, clothing, all the basic stuff we need. And then there's the wants. And I mean, you could have $5 million of cash in the bank, but maybe it's not the best time to go out and buy, $1 million vacation home right now, if you're in a position where your income drastically dropped, so, or buy that new car. Maybe it makes sense to wait a little bit longer. And so those are the just kind of basic blocking and tackling that we kind of talk to people about, and we coach them just to make sure they're not spending excess money that they don't have, or not positioned to really, spend right now. I mean,
I
it's a big
agree.
thing because we've been kind of spoiled the last couple of years. Not in the sense of COVID, obviously, but in the sense that like we've been able to go out. There's been money has been easy, credit's been easy. We've been able to go out and kind of do whatever we want as far as spending goes. And now that we have inflation in this environment, which could be short-lived, could be long-lived, we don't really know the extent of how long the duration of this is going to go. But I do know that things are costing more, and they're probably going to be elevated for the foreseeable future.
Absolutely. And I find that you can use this for your business, because this, I know he talked about the personal and the credit cards and all that stuff, but it is really important for businesses, because at this point, let's say we have several metal manufacturers, and because of the issues of not getting the supply, we've bought a lot and their inventories are really high. This is the time, not waiting the 6 months that it's going to take by the time that all of it comes to light. I mean, I know that everybody's on TV listening to, are we in a recession? Are we not? It's 2 months of low. I don't know. It's Chinese to me sometimes, because I don't understand it. But what I do understand is, wait, I have to slow down. Make sure that you're reviewing your monthly financial statements. Do not review them, because that's how you make your management decisions. And sometimes you're just so caught up in the cash flow of it that it's hard to really see it. So make sure that you read your financial statements, do the comparison reports, look at the revenue projections for the end of the year, look at your inventory and see if you're aggressively bought too much and now are going to need the next 5 months out of the year. I can't believe that it's August already. So we're on easy. Here's the fall, and here's the third quarter. So it is important to just stop a minute and make those decisions sooner than later, especially all of us here that are small business owners. You wait too long and it's too late. So make sure that even though your bank lowered maybe your line of credit because during COVID, your sales went down, and that's totally okay. Well, get on that line and try to see if you can bring it back up, because you will need it. So just get prepared is the big question that I have. And I know that it's easier said than done, because I'm not in your shoes on the everyday that I just gotta find employees. Believe me, I'm there too. But sometimes it's so overwhelming. You now are paying way more for wages than we have ever paid before. And you have a lot less control because people are so flexible. It's an interesting concept. I know we spend a lot on IT and AI. It's amazing. We now have a partner that only does that. And it's amazing. I didn't even know robots could pay your accounts payable, but hey, it might help you reduce your cost of employees, which normally can be really high. So aside from the market and all that stuff, I encourage you to really take a moment, and you should at a minimum have your June 30th, 2022 financial statements internal, and you should be meeting with your accountant or your controller or your CFO or whoever's your advisor to say, okay, at least you're there. So I'll stop preaching. Sorry.
Okay. I mean, this one's pretty commonplace, but when you go to that place where you have a surplus, the first thing you want to do is build 3 to 6 months of living expenses. If you need $10,000 a month to live, probably want to have 30 to 60,000 in some type of liquid savings account just to cover unnecessary costs or emergencies that come up. And in prior years, people have used HELOC or credit to have that. And I do think that like in this type of environment, having cash or cash equivalents, CDs, treasuries, things that are completely liquid with the push of a button is a better way than just having like lines of credit. Because again, what happens during recessions is that the Fed raises interest rates and monetary conditions tighten, and credit doesn't dry up necessarily, but becomes much tighter. So those that have cash don't have to deal with, those tightening conditions, and it just builds a cushion. For a lot of people who are younger, having 3 months is really difficult because they don't have income. If you're older, you should definitely have 3 to 6 months. But it's just, again, a mindset of put what you can away in savings so that, if something happens that, proverbial, something happens and it breaks, you have some money there. You just don't want to be in a position where you don't have any cash when you really, really need it. Again, this is
Absolutely.
from
Robert,
personal and from a business.
Yeah, I wanted to have you talk to us a bit about cash management programs.
Mhm.
On the other side, there is a lot of cash out there. The government gave a lot of money out, and there's a lot of people holding cash. And because of the potential recession, people are holding on to the cash and wanted to be as liquid as possible. And we wouldn't be telling you this 8 months ago, but interest rates are like, what is it now, Robert? You can do, if you, whether your business or whether you're personal, and you're holding on to a few $1 million that are just sitting there and you don't really want to mess with it because what if, don't just leave it in a checking account with a bank.
Yeah.
Munis and things that you can easily trade. Can you talk a little bit about that?
Yeah. So, we have a number of controllers, CFOs, and business owners that have been moving cash, significant amounts of cash that are on their balance sheet. They might be being repurposed or used for M&A, or it's just, operating expenses, types of accounts. And just to give you an example, if you went back a year ago, yields on cash management were sub 1%. If you got 50 basis points, you were lucky. You go to B of A or Chase or Wells or any of the big institutions, just in a normal checking account, it was like 0.02. Now that the Fed funds it's trading at 1.75. The Fed's meeting today and tomorrow. So whether you get a 75 or 100 basis point hike, no one knows. But the point of it is those rates are going up, and we can get short-term institutional quality cash management strategies that, let's say, have a 1-year duration and you're getting 2.5%. So you can get in the 2s and now possibly in the 3s on some stuff that is relatively safe. And it's just a better place to park your money rather than just having it sitting in a checking or savings account. And we haven't seen these types of yields in the last 12. It's been about 12 years since the yields have moved up now.
Wow. So
Yeah.
how liquid is that money?
Everything is completely customized to the client, but you can have a portfolio that's liquid with push of a button 1-day liquidity. You can tie things up for 3 months, 6 months, 9 months, 12 months. The longer you tie up your money, the higher the return that you get. But to give you an example, let's say you're a business owner and you're going to make an acquisition in a year from now, and you've got $10 million in cash, operating cash. They might park 5 or 7 million with us and lock it up for 12 months and be able to capture a 2%, plus type of yield on cash equivalents. I mean, those are great returns. We haven't seen that again in the last decade. And as the Fed continues to raise rates, we don't know how high they go or when they stop. But for the foreseeable future, at least the next 6 months, we're going to be in a really great environment for this type of stuff.
Absolutely. What I really like to bring out is I understand that it depends on who or what you invest in, but even at the most liquid, so let's say the most liquid that you can have, can you get up to 2%?
On the most liquid, not quite, but again,
1%.
it moves around differently, but like, let's say on institutional money market, you can get 1% right now with daily liquidity.
Well, and I'm sorry, but on $1 million, that's still money.
Yeah,
On
it's
$10 million,
real money.
that's still
Yeah,
money.
it's real money now.
That's what
So,
I mean. It's like, and plus it's insured versus, if you do have $8 million and it's all sitting with bank A, there is limitation. Not that, God forbid, nothing's going to happen to banks. We're not going to go through that, hopefully, again in our lifetime. But I'm not comfortable if it would be me having $1 million between 7 accounts, but it's all with one bank. Not the best thing to do. You have to be smart too. So
Yeah.
controllers are listening, make sure that you do that. It's, your fiduciary responsibility too. You've got a lot of not-for-profits, whether a union, whether you're a, 501c1, 3, and all that stuff. A lot of these companies, of these organizations have a lot of cash right now. It's really important that you're using it because it is your fiduciary responsibility. 12 years ago, 12 months ago, you couldn't, but now that you can, and you can do something for your members and for your people, you should do it. Just pushing it a little bit more.
So yeah, here, I'll flip to the next slide here. Again, going back into credit. So when you're, doing planning, you look at assets and liabilities. Everyone always focuses on the asset sides, building real estate or liquid portfolios, retirement accounts, cash management. But what's really also important is to look at the liability side or the debt side of your balance sheet personally and as a company. And, I always tell people, check their APRs. You might be shocked to know the APR of your credit cards. You could have the choice of having maybe credit card A versus credit card B using for, again, individual or business. And one could have a 10% APR and another one could have a 29% APR. So obviously you want to use one with 10% versus 29. As interest rates go up, credit card companies are raising their rates. So if you're carrying balances, that significantly can affect the interest payment that accrues on these things. So you definitely want to be checking those. And, one tip that, one actionable tip is, just calling your credit card companies and doing two things. One, asking for higher limits, and two, asking for lower rates on your balance. And the worst they can do is say no. And in which case you just hang up, you wait a couple hours, call back at another rep and ask again. And if they say no, then you hang up and you call again. You keep doing it until you get what you want. Not saying that that's 100% going to happen, but if you're consistently asking, what I've found from other client experience is that they will raise rates, raise the limit and lower your rate on the credit debt. By increasing those rates, you're increasing what's called your credit utilization or the availability of credit. And by expanding your credit base, you also are helping your FICO score go up because it's showing a lower balance because now you have a higher limit. Obviously, you have to be responsible and kind of respect those higher limits and not stretch it too far. And during this process, I look at your car loans, look at student debt, look at personal loans. One quick tip with student loans is that we went through this period of COVID where they deferred all the interest payments on your student loans. So you could have a kid who graduated and has 50,000 loans, and they have a 10-year repayment period, and all of a sudden they didn't have to pay during that time. It was just kind of deferred. Government was paying the interest on those federally backed loans. If someone in that position has income and they have the ability to make their normal payments, I say 100% make your payment and write principal only on that payment. If they have the ability to do double payments, write principal only on double payments. And the reason why you do this, again, any type of debt that's deferred or someone else is subsidizing it, you have a freebie, meaning like instead of you amortizing the loan, you can take the extra money and pay it straight down on principal. So to give you an example, a payment for someone who has a $300 student loan payment, if they paid $500 on that, so $200 more, and there's the interest being deferred and they write principal only on that payment and they did it for 2 years, they just knocked off close to $12,000 plus on their student loan over a 2-year period. So there's some really smart things you can do to knock those debts down. Another thing that a lot of folks don't know is called a loan recast. So we were in this period of time for the last, let's say, 6 years where interest rates have been going down. The 30-year fixed mortgage rate, kind of peaked or dropped to the high twos, let's call it 2.7, 2.8, somewhere around there, which was a really low historical rate. And so lenders had, called people who were borrowing debt to refinance their loan. And everyone was like, I'm lowering my payment. I'm going to refinance my loan. I have a lower rate. But what they don't realize is that every time you refinance, even though it might seem like in some case, a no loan or no cost loan, is that you're now resetting the amortization on your loan. So you were 10 years into a loan, you refinanced, your payment dropped, but now you have another 30 years on your loan. So you're really paying 40 years, not 30 years. So a trick is you can call your lender up, and assuming you pay down your mortgage over a period of time and your balance is lower, you can ask them to recast your loan based on the new balance. Meaning, I had $1 million loan. I've been paying down, over 10 years. My loan's now 720,000. I can basically recast my loan, meaning my balance is 720, but my loan payment will reset. The rate and term stay the same, but they'll reset to that 720 amount versus the $1 million. So my payment went from 5,000 a month to 3,000 a month, cost me almost no money, and I'm still under that same amortization clock. So I'm not paying more interest, but now my monthly payment is much lower. People can also, if you're paying more than 5,000 at B of A right now, you can call the bank and you can literally pay a chunk of money on your loan and recast the loan. There's no qualification, and you just reset the loan payment. So these are all things, if people, ping me offline, I can explain how this stuff works. The big picture is just, you want to look at your rates and your terms of all your debt, whether it's, personal or business. You want to try and restructure and just make sure you're not in a position where your stuff's in all this variable where it's going to jump up, and you want to lock the cost of your debt down. A lot of corporate America has done this already too. If you look at large companies trading in the stock market, a lot of companies have locked longer term, low interest rate debt over the last 2 years.
I love it.
Okay.
Thank you.
So let's flip to the next one, where Maria, I'll let you take over this one.
Okay, well, I don't know if any of you guys are even remotely gone through all of the stuff that we went through back in the 80s and then in the 2000s, but hopefully we've learned. I totally get that we have to pay employees, but if we would be doing our budget and we would be doing our flow in projection, you can make decisions sooner to say, okay, well, when should I be stopping trying to keep these employees by me getting into more debt? So the more that you have knowledge, the faster you can make these decisions. Because back in the 80s, when one of our recessions happened, or actually it was worse than that, what we ended up having is a lot of employers kept paying the employees, but we got into such big debt that it was almost impossible to get out of it. So if it means, okay, I'm going to start cutting down because I see that this market, the supply chain issues and the demands issues are going to be lowering, I need to start planning right now. So I think that's important. Another thing that it's important to say, you've been using research and development credits for a few years, and that's all great and good. But what happens is we get into, in fact, I just met with a client a couple of days ago, and he said, you're right. You get into the routine. Oh, I got to send the R&D guys the same information and blah, blah, blah. And you forget that it's a moving thing. R&D is not that you're always going to be figuring out how to do something better, that you're research and development in all the terms of the word. That word is so big. Even if, let's say, you're in trucking and you figure out your whole logistics and you have a new program that you put together and you have people that have done it, that's R&D. I know it sounds kind of crazy, but it really, really is. So don't get stuck in, oh, it's just another year, I got to get that, because then you'll get to the low-hanging fruit only. Instead of that, every year make an effort to say, okay, how much, what would I have to change to get more? What do I have to do? Do we have to write it down differently? Do I have a mentality different? What does it take? I don't like it when you go to somebody and they say, no, you can't use that. After this many years in business, there's a will, there's a way. So I think it's really important. Continuing that also that's not in here, the 199A, it's gonna be until 2025 when you still for small businesses, get that 20%. If you have wages, keep reviewing that, looking at that and say, okay, is the wages that I'm paying now reducing my 199A credits? So review all of that, make it fresh every year, because you will be surprised how much more you'll be able to get out of it. It's really what it comes down to in my eyes. Obviously, employee retention credit, if you haven't done it, I really encourage you to absolutely check it out. In the retention credit, it's basically you're going to refund on your employee payroll, and it's worth a look. It doesn't mean that you necessarily have to have 25% reduction in sales. There's a lot of other ways that your business has suffered that you can use to do that. It's just, for me, look at it, spend the time, because you can get a lot out of it. And at the end of the day, most of these consultants, they're not going to charge you unless you get credit. So what's negative for you? None. So in my opinion, preparing for the slowdown that's going to come, that is probably already here. I mean, obviously, we already know that the businesses that are really already suffering because of supply chain issues, and we have now slowdown of demand. It's already here. So I would say really make sure that you prepare.
Yeah, I mean, that's a good, to Maria, to your point, is recessions or market downturns are, scary events, but for those that are well prepared and kind of have the mental fortitude to stick through it, it can present opportunities, both on a personal side and also on a business, opportunity side. It's just, you have to have the cash flow and the balance sheet and kind of be prepared when this thing hits.
Absolutely. I mean, there's a lot of our clients that are still doing very well. And frankly, I'm having a hard time just finding ways to save a couple of bucks in either credits or something. So sometimes it's right in front of our noses that we have to do a little bit more, push a little bit harder, make a little bit more effort, and we will find the fruits of our labor.
So, Maria, there was a question here from one of the participants. Would recasting work towards the end of a personal mortgage, home mortgage? And so Anita had asked this question, and the answer is yes. However, I don't necessarily know if that's the best use of doing it. And the only reason I say that is it kind of depends. I hate to say that answer. It depends on the rate and the terms of the mortgage. It also depends on how much is left, like meaning, is it like 3 more years left on the life of the loan? If it's less than 5 years left on the life, you're like 25 into a 30-year loan, I would say it's probably not worth it. Just let it amortize down and pay off. If you're less than 10 years into the life of the loan is where recasting makes a lot of sense. And it also depends on what the interest rate is and what type of rate it is. Is it a fixed rate already or a variable rate? So again, if you email me like individually, I'm happy to take a look at it and answer that for you, because it's really
Or
specific.
truly, yeah, or truly call the mortgage company too.
Yeah.
And talk to someone there. The key to doing that is just make sure that most everyone in this room probably has went through the interest rate reduction. The only thing you want to make sure that it only gets recasted, that it doesn't get changed, because that may be, and right now refinancing business is not doing well. So there are a lot of fancy things that they're bringing to the table now, because they're trying to also get their business moving. So there's always a possibility, I would say, in times like this is when people's minds move even more into, okay, what can we do? Think about all these refi companies that are seriously have a huge reduction in their sales force. They're doing a lot what they can just to get it moving. So I would definitely make a call.
For sure.
So Robert, we actually had another one come in. I know you've answered this, but it may bear worth repeating. If you have the choice to put the money into retirement versus lowering your debt, what is the best option right now?
Okay, so I would first look at your debt and see like how big is it relative to your balance sheet. If it's small debt, I wouldn't really focus on it too much, but is it credit card debt? Is it home loan debt? Is it personal debt? Like, I mean, it depends on what type of debt, because not, in my opinion, like most debt is bad debt unless it's attached to something that's growing in value. So if it's, rental property or home loan debt that's fixed rate, I would leave it alone, assuming you have good rates. If it's credit card or car loans tend to be fixed, but like credit cards tend to be revolvers, meaning they move up with the Fed moving interest rates. So if it were me and you had large credit card, I would pay the credit card debt down first, or at least get it into a manageable position. Make sure your other debts are fixed rate and they have good rates. And if that's the case, then you want to flip it into retirement savings. And again, that could be a 401k, an IRA, some type of, plan that your company has. But, you definitely want to start investing in retirement assets because, most Americans don't have enough saved up. So lock your debt down, make sure it's not variable. If it's high variable rate or personal debt, pay that off first. And then secondly, then after that, rotate it into retirement accounts.
Agreed.
Okay, and I think this one you had also answered in a roundabout way, but it's worth repeating. I have large cash balance in our business account with expectation of needing it when and if the recession hits. What should I do with it now?
Okay, so if you're a controller, a CFO, or a business owner, and you're looking at your business and you have operating costs, you want to try and match the duration of the cash to the operating needs of the business. So if you need, let's say you had $5 million and you knew you needed $1 million, in 6 months, and another $1 million in another 6 months, but the initial 3 you didn't really need for now, what you can do is structure a cash management portfolio that's tied to the duration of those cash needs. So you have some stuff in there that matures in 3 months, maybe some stuff that matures in 6 months, maybe some stuff that matures in a year. So you can kind of stretch it out and get the most yield that you can get right now. But then that also, you're not locking your money up for, extended periods of time. You're kind of matching the duration of the money with the cash need, and then keeping another portion maybe daily liquid. So all of this stuff can be completely customized to a business owner's needs.
So that is all the questions we have. Before we close, Robert, when we were planning this, you, Maria, and I, this webinar, I know you and Maria brought up several times that this has happened. It's cyclical. It's happened before, and it's going to be okay. So would you mind reiterating that positive statement before we close out?
Okay, so I'll just, in closing say that, recessions happen, downturns happen. They're a natural part of the business cycle. No one likes them, but they're a normal part of the cycle. This type of stuff has happened before. We have had inflation. Every time feels a little different. Every time, is a little different than the prior events, but, the human psychology of fear and greed and how markets work, I don't think that's ever going to change. And as long as you're planning and you're prepared, you're going to be okay. We've been, like I said, we've been through challenging times before, and we'll get through them.
I agree. It's fascinating to me that oftentimes the fact that the market is down has absolutely nothing to do with the actual businesses that are out there doing very well, that have cash, a ton of cash. Their financials are looking well, but emotionally, the market has not been happy about it. There's, the people are afraid to do it. And so to me, it's very interesting to see how one thing has not that much to do with the other. So just saying that we are going in recession does not mean that all the shops are going to close down, that everything is going to, it's just not going to. It will come back. You just have to hang tight and be smart and do budgeting, and especially for business that let's say non-public, that are considered small businesses when you're not public. You can be banking 50 million, but you're still a small business. You got to be on your toes, making decisions fast. And in order for you to make them, unless that you're the old time, I have $1 million business and I know intuitively, and God bless you, those that have it in here, not all of us can do that. If you're not one of those, do your homework, get your job done, do your, do your planning, do your budgeting, do all of that. It will help.
Yeah, and build a team. Like Maria
Yes.
says, our best relationships and the most successful people we know have built a team of advisors and people around them that have their best interest and care about them and can provide value with all these different topics that they might not be experts in. So just to surround yourself with people who care about you and have your best intentions and, build out that team.
Yep, absolutely.
And with that, I think we are done. So I want to remind all of you to be on the lookout this afternoon for an email that will contain the slides and a link to the recording so you can listen to it again or share it with friends and coworkers. And we want to thank you again so much for joining us. Thank you, Robert. Thank you, Maria. Always
Thank
being
you.
so helpful to those of you out there. And we want to thank all of you for joining us. We know you're really busy, so we appreciate you spending an hour of your day with us. And until next time, have a great day.
Thank
Bye-bye.
you so much, everyone. Have a nice rest of the week.
Yeah, thank you.